Welcome everyone to the second part of the webinar series on the IFRS Sustainability Disclosure Standards. My name is Yana Mudronyeva and I am the SBFN Data and Disclosure Working Group Coordinator, and I will moderate today's session. This series is hosted by us, Sustainable Banking and Finance Network, and the IFRS Foundation. As you might know, SBFN is a voluntary network of financial sector regulators and industry associations from emerging markets committed to sustainable finance. Currently, we bring together 97 organizations from 72 countries representing over $68 trillion, which is 92% of total banking assets in the emerging markets. And we are proud to have this long-standing collaboration with the IFRS Foundation, and we support our members and partners in improving sustainability practices for greater transparency and accountability. We know that the global landscape in disclosure is fast evolving and that investors' demand for more accurate, material, and comparable data is increasing. And financial sector, those of you today here, have played a key role in driving some of the most ambitious changes in the way businesses operate, including ensuring that environmental, social, and governance risks are managed, that people's lives are protected, and that the jobs are created. While in our first session a month ago, we talked about why disclosure matters, in today's session, we will dive deeper into how countries go about to regulate disclosure and what decisions they need to take when designing their approach. We are also very fortunate to have with us Mr. Chaudhry Liaquat Ali from the Bangladesh Bank. Bangladesh Bank has been SBFN member since our launch in 2012. As the central bank, it has been very active in overseeing and guiding the banking sector towards greater sustainability, both in terms of risk management, reporting, and directing capital to sustainable activities. And today we will hear from Bangladesh Bank about their experience in adopting the ISSB standards. And with this, I would like to hand over to my IFRS colleagues, Jonathan Bravo and Mosireleti Mokokwane.
Thank you very much, Jana and Taiko, for again allowing us to team up with SBFN to deliver these sessions. And we are again really pleased to be able to hook up again with SBFN members. Just a recollection of the first session we had with all of you. We had the opportunity to get into some of the details of the jurisdictional guide and how we are working together with partners as we're rolling out our regulatory implementation program to support jurisdictions in the process. The purpose of the session today is to give you an introduction of the Jurisdictional Roadmap Development Tool and deep dive into two of its pillars, some of the key decision areas that are intended to support the jurisdictions through the thought process that is needed in order to put together a project plan, a roadmap towards the adoption or rather use of ISSB standards. And as you can see from the slide that's being displayed on the screen, we have noted what is an illustrative journey that a jurisdiction will follow as they introduce ISSB standards into its regulatory framework. It starts, of course, with becoming familiar with the standards. It has a component of assessing the case, trying to articulate what is the policy rationale as to what are the benefits that the introduction, the adoption of ISSB standards can bring to their capital markets, to its financial system. But the main purpose of the Roadmap Development Tool is precisely to support and assist jurisdictions, regulators, or authorities that have already made a decision that ISSB standards can be the enabler to strengthen their capital markets and how they can come along, I think, with the
Bravo,
adoption.
just intervene you, your slide not visible. So everyone request to you this presentation mode.
Thank you very much, Mosi, for that. So again, the purpose of the Roadmap Development Tool is precisely to support those jurisdictions that will be putting together a project plan. And we'll talk extensively about what are the benefits of developing a roadmap and two of the first decision areas that will be meaningful in the process. But of course, developing a roadmap is just getting started in the journey. There will be jurisdictions that will need to give some shape and form, and we will touch as well on later on in the third seminar as to some other important areas for consideration. If we can move to the next slide, Mossy, please. Again, what is the benefit of having a roadmap? And of course, all of you regulators, you can pass regulations right away. But given many jurisdictions are going to introduce transitional components over time, they will be onboarding different entities at different times. They will be enhancing the comprehensiveness of the requirements that will compose their regulatory framework. We believe that the development and the communication of a roadmap is valuable in the sense that it can set clear objectives, clear milestones. It provides visibility to those market participants that will eventually need to make use of the standards. Companies that will be required to prepare disclosures in accordance with ISSB standards, as well as investors that will need to assess the information they're receiving from companies. It helps assign responsibilities, measure progress. It also ensures there's a degree of accountability, someone that can follow on the decisions that have been made. And importantly, it can identify the dependencies within the ecosystem, the different regulations, the resources and expertise that may be available, and put them at the service of a concerted jurisdictional effort. We can move to the next slide, please. Again, the objective of the Roadmap Development Tool is really help regulators, authorities in the planning and the design of their roadmap, and particularly assess the implications of the decisions that they make and their respective approaches, how well the decisions, the approaches will achieve their stated objectives, how the approach will be understood by their capital market participants, as well as other stakeholders that will have an interest in how the jurisdiction is progressing with the adoption journey. And finally, but also importantly, how the jurisdictional approach will be described by the IFRS Foundation in the jurisdictional profiles. And as we mentioned, I think previously, this is something that we will be doing in the course of the next couple of months. So the basic structure of the Roadmap Development Tool, it has a tool itself. It presents in tabular form, again, has 4 decision areas, the 4 Rs, and we'll be covering the first 2, the regulatory process and the reporting entities today. But for each of the decision areas, it includes some overarching guidance, some key matters for consideration associated to each of the 11 features that we had the chance to discuss in the first session, a checklist of decisions and a spectrum of outcomes. And against the tool, we're also making available what we call roadmap templates, which again can be used to inform what is the description of the jurisdictional approach, both its current status, how would the jurisdictional approach be described as of today, versus what is the jurisdictional target. Once the jurisdiction has reached its final destination in terms of its final regulatory framework, how it will be described. We can move to the next slide. So again, you will recall that we mentioned previously, there are 11 features in the jurisdictional guide. So what we've done in the Roadmap Development Tool is organize all those 11 features under 4 decision areas, the 4 Rs. The first one is how can jurisdictions get started with the process? What's the regulatory process? And this is one of the sections we will be looking into today. So the regulatory and legal standing, it's the feature that is articulated in further in the Roadmap Development Tool. The second area is, again, who will be subject to the requirements? What are the reporting entities? And this is the second area that we'll be looking into today. We'll leave the area around the what, the requirements, and the when, the readiness for the third program. So stay with us for the first couple of decision areas that we'll cover today. We can move to the next slide. This is just a recap of the information that was shared with you as part of the jurisdictional guide. Those 7 templates that we have developed are grounded in the 7 jurisdictional approaches that we already had the chance to introduce a month ago. So the 7 descriptions are available. And if we can move to the next slide, we have developed templates for each of the 7. And you can see on the right-hand side of your screen each of the features with a spectrum of outcomes, and you will see that those described in green are the ones that would enable the jurisdiction to be described as fully adopting ISSB standards. So one of the benefits of the Roadmap Development Tool is that once you've gone through the 4 decision areas covering the 11 features in the jurisdictional guide, on the basis of the matters for consideration and the outcomes that you have decided as a jurisdiction that you want to achieve, you can actually contrast all of those with those 7 templates that are aligned with the descriptions that we have in the jurisdictional guide. So I think without any further ado, let's perhaps move into the first decision area around the regulatory process. So the how, and many of you are regulators, so this, and we have a combination, I think, of capital market regulators, prudential regulators, central banks. So I hope that this will resonate with many of you. You can move to the next slide. The feature we had in the jurisdictional guide was, again, one of the aspects you should be considering is how you will be introducing through law or through regulation a requirement to apply ISSB standards, or again, introduce sustainability related disclosures into your framework. If we can move to the next slide. The first one is, of course, just determining whether the jurisdiction will indeed introduce a legislative or regulatory requirement. And again, there are different outcomes that are possible. Jurisdictions may decide to permit the use of the ISSB standards and have a legal provision to permit the use. Some may take no decisions at all, and some may evolve from a voluntary reporting regime into a mandatory reporting regime requiring the standards. So that is the first determination that drives very much whether the approach will be one of the 7 descriptions that we had in the jurisdictional guide. As you will see from the slide, I think there are important considerations that while they do not really deliver any specific outcomes in terms of the jurisdictional approach, we think these are important questions regulators should ask themselves. The first one is whether there are any existing laws or regulations that do touch on sustainability-related disclosures or reporting. Whether there are any implications of extraterritorial requirements, either stemming from your jurisdiction into third countries or vice versa, regulations in third countries that may have a bearing on your own reporting entities. Again, I think it's important, and we were touching before, there's a different spectrum of regulators. I think it's important to identify what are the interactions between the different jurisdictional authorities, whether there are any supranational. And I think, for instance, Europe is a good example. There is a need for the national authorities to engage with the European bodies in order to determine what's really the framework that's going to prevail. I think it's important as well to identify whether there are any existing laws or regulation that could trigger any misalignment or conflicts with the introduction of ISSB standards. And again, in terms of outcomes, if we can move to the previous one, you will see that in outcomes, those are the ones that will eventually feature in the template. So once you've gone through some of the matters for consideration, you will be able to contrast each of those. And again, there's an Excel tool that is available where you can fill in all those decisions, and there's a drop-down menu where you can pick what is the outcome that you think is suitable for your jurisdiction and contrast against the template. We can move to the next slide, Mosi. So again, I think there are different instruments that are available for jurisdictions to pursue and different regulatory models. And here we just wanted to signal some of the pathways that different jurisdictions have followed. I think there's elements where the government has been taking legislative action. This is the case, for instance, in Australia and in Turkey, where both the Australian Treasury and the Public Oversight and Accounting and Audit Standards Authority, which belongs, I think, under the Ministry of Finance, have already set regulations. So it's directly through laws and regulations coming from one of the policymakers or from the government directly that have the effect to introduce ISSB standards into the jurisdiction's legal or regulatory framework. In other instances, it's directly the securities regulator This is the case, for instance, in Brazil, that has issued regulations to that respect. And there are different regulatory instruments that securities regulators issue, stemming from regulatory bulletins or resolutions that can subject entities to those regulations. We will be looking on today, so I don't want to front run the presentation that Mr. Chowdhury will be giving with respect to the central bank, but of course central banks also do have a role here in introducing requirements for financial institutions as a key institution with a key role in the ecosystem. In other jurisdictions, we've seen the stock exchange charting ahead. This is the case, for instance, in Singapore and in Hong Kong. And we will see later on that it's not that they have issued listing rules on their own. They have operated in the context of a cross-agency type of committee bringing together the different regulators. And in other jurisdictions, and this is the case that will resonate with many of our African counterparts and members today, the standard setter, the public accountancy organization, which operates as well as a standard setter, they have the ability to issue regulations. So as you can see, it is important for authorities to identify which is the regulatory landscape in which they operate in order to determine what is a suitable pathway for them to follow. And again, we are inviting jurisdictions through the Roadmap Development Tool to ask themselves those questions. And I think it's important for jurisdictions where you have multiple regulators with different mandates, with different responsibilities, to come together so that there is a comprehensive jurisdictional commitment behind the adoption of ISSB standards. If we can move to the next slide, again, just trying to point out to some examples that you may be able to relate to, which is starting on the journey to adopt or otherwise use ISSB standards by permitting the use. So again, introduces laws allowing entities to use ISSB standards. And again, encouraging as well their use, which is different from a more direct requirement. There are a couple of jurisdictions that we have put together as examples here, Brazil and Nigeria, that they have taken this route in order to build capabilities within their markets before they require the application of ISSB standards to different reporting entities. So in the case of Brazil and Nigeria, they both allowed through regulations the use of ISSB standards. There's a direct encouragement for entities to use them, but there is no prescribed application from a regulatory standpoint. They have already anticipated, and regulations have been put together, that from January 26, in the case of Brazil, in the case of Nigeria, from 2028, they will be onboarding a subset of the entities. And again, they will make this more comprehensive. What's important here, and we will look into that later on, is whether public accountable entities are being subjected to the regulations. There are other jurisdictions, for instance, El Salvador, that have passed regulation permitting the implementation of the standards, but they have not anticipated at this stage whether they will be making those disclosures mandatory. We can move to the next slide. Mossy, thank you. I think it's important for jurisdictions as well to consider whether and how and what is the best mechanism for them to introduce the standards on the basis of evolving, updating, refreshing some of the existing laws and regulations. And we've provided here 4 different examples. In the case of Chile, the regulator had prescribed the use of the TCFD recommendations as well as the SASB standards. So what they've done is they have already anticipated that from year 2026, those requirements will evolve into ISSB standards, which seems a very reasonable stage because, of course, ISSB standards embed already TCFD and SASB standards. So it seemed like a very logical approach. In the case of the UK, they had introduced requirements on the basis of the TCFD recommendations, and they will be undertaking soon a process to endorse ISSB standards for the use in the UK. In the interim, the securities regulator, the Financial Conduct Authority, has again encouraged the use of ISSB standards as a way to meet the existing TCFD-based requirements. There are other jurisdictions, like it's the case of Hong Kong, as in the case of Singapore, that they have basically evolved their listing rules, replacing the pre-existing framework or updating the pre-existing framework on the basis of ISSB standards. In the case of Hong Kong, they have updated what they call Appendix 27, which are the listing rules. And on top of that, they have issued a roadmap setting their own standards that are fully aligned with ISSB standards. So again, different examples of how jurisdictions may be considering their existing laws and regulations in order to evolve and introduce ISSB standards. If we can move to the next slide, Mosi. One thing that we're inviting jurisdictions to reflect upon is what is the compliance basis that will prevail in the jurisdiction. And again, whether it will be mandatory, voluntary, whether it will kick in immediately, or whether it will evolve, for instance, from a comply or explain basis into a fully mandatory regime. So again, as far as there is regulation requiring the application of ISSB standards, some of these considerations may not necessarily lead into a particular outcome. And again, we believe that it's important for jurisdictions to think right from the get-go, what is their due process as regulators in terms of consulting market participants and stakeholders. And I'm sure that we have plenty of members that will have different provisions with respect to their own consultation obligations. If we can move to the next slide, just giving perhaps an example of how different jurisdictions have made use of the different consultations. I think Australia is a good example because they issued Australian sustainability disclosure standards based on IFRS 1 and IFRS 2. It's true that some of the original proposals didn't fully incorporate some of the elements that were in S1 and S2, and we were pretty encouraged to see how the different stakeholders weighing in the consultative process have actually highlighted the need for a jurisdiction like Australia, who's really interconnected in the global markets with many of its market participants, again, doing business, doing trade, having listings in other jurisdictions, the value of aligning with the global baseline. So what the Australian standard setter did was fully align their framework with that in IFRS 1 and IFRS 2. And again, you will have seen that in Japan, they have recently issued the final standards following an extensive consultation process. And they had again determined very much the intention to align with ISSB standards as the basis for the development of the Japanese standards. So those consultation processes have helped the regulators identify those areas where perhaps stakeholders need a greater degree of alignment, even in the context of the jurisdictional circumstances. So it's important that all of you ask yourselves, before you get started in the process, what's the consultation process that I'm subject to, or how I may want to ensure that I have buy-in from my markets by consulting and making them aware and participating in the proposals we're putting together. If we can move to the next slide. Here it's important as well to consider what is the adoption process that a jurisdiction will follow. We saw before that some jurisdictions have established their local standard setter. That requires, of course, putting together resources, technical expert resources, to be able to draw the standards. And it's important to think as well, not only on the short term, but on the long term dynamics. And you will be, some of you that may be following the developments in the IFRS Foundation, you will have seen that we have published recently an exposure draft on proposed amendments to IFRS 2. And the reason is because, of course, our standards are market-driven, market-ready, and we are very keen to address some of the implementation questions that have come to our attention. So jurisdictions will need to ask themselves whether it is an effective use of resources, building, developing a local standard setter, whether for the jurisdiction, for its own resources, for a level of expertise and its regulatory structure and landscape, whether it is preferable to look into an assessment process where ISSB standards can be adopted directly into the jurisdiction. And again, I think it's important to determine the different roles and responsibilities. I've touched on that before, but we believe that it's important to build up a cohesive and comprehensive framework that allows building consensus, coordination, synergies between the different regulatory pieces. And we will see probably later on when the Bangladesh Bank speaks about its own proposals, how for financial institutions, it's important that they also gather, collect, and assess sustainability information from entities in their value chain. So it's important that jurisdictions build a comprehensive framework altogether. We can move to the next slide, Mosi, again, just trying to give some examples of how some jurisdictions have worked out their different roles and responsibilities coming together. And again, giving some different examples here, I think Malaysia is one of those jurisdictions that has grouped under what they've called an advisory committee of sustainability reporting, which is the body that has issued its national sustainability reporting framework. So bringing together the standard setter, the stock exchange, the securities regulator, the central bank, and again, using this group to reach out also to the different stakeholders in the jurisdictions. This is very much the model that has also been applied in many other jurisdictions, but has been the case in Hong Kong, has also been the case in Nigeria. Again, we will see, and this is probably the case in many African jurisdictions, and I'm coming from the African Congress of Accountants, which is taking place this week. A lot of African adoption champions are coming from the accountancy profession because they do have the powers, the mandate to develop national standards, and they are actually the ones that can actually make determinations on how company laws do operate. In the case of the UK, for instance, it is a government-led advisory committee. They've actually set 2 committees under to advise the Department of Business and Trade. One, bringing together some technical experts under the Secretariat of the Financial Reporting Council. They've also set together what they call a policy implementation committee, bringing together other views. So 2 technical committees advising the government as to what is the approach that should be followed in terms of the endorsement. And again, we reflected before on the case of Brazil. We can move to the next slide, and I think this is important for those of you that are thinking, well, we have an interest in ISSB standards, but as a matter of fact, we initially need to ensure that if we're going to engage our markets, we make translations available so that we can engage. And I think it is important both for translation purposes, but also for jurisdictions to be able to use and refer to and build from ISSB standards, that you become aware and acquainted as to what are the procedures that the IFRS Foundation has in place. So again, you'll need to ask yourselves whether you will be introducing all the standards, whether you will be reproducing all the content, parts of it, whether you will be retaining the name, whether you will be what we call adopting by reference versus building your own domestic framework. And again, it is important that this is brought early on because generally it takes some time to develop, I think, the process, and it's good that there is a proper reflection of how your adoption approach is being planned, because that there may be different avenues for using ISSB standards in the jurisdiction. So if we can move to the next slide, Mosi, just again, giving some examples of how different jurisdictions have progressed, I think, with translations and licensing arrangements. We just wanted to note, for instance, some jurisdictions that have adopted by reference. So this is basically making sure that their laws refer to IFRS sustainability disclosure standards as issued by the ISSB. So that's the requirement in their regulation. And that again prevents having a licensing because they're basically referencing the standards directly in the regulation. So that's the case, for instance, of Mexico, Nigeria, Tanzania. So again, many global South jurisdictions are actually using this method because it prevents probably them from having to devote their resources specifically to set their own requirements. And for jurisdictions that understand they will need to build capabilities and ensure market readiness throughout their journey, it's important as well for them to ensure that they devote the resources to what may be more efficient. Maybe it's not drawing domestic standards, but supporting the implementation. And this is an important consideration, I think, for from the get-go. It's important as well to make those translations available. So there are some the ISSB standards and some of the educational materials have been translated into some languages. And of course, there's generally a promoter within those institutions looking for the translation. So it's the case, for instance, in South Korea, in Japan, in Canada, Brazil, Turkey, and many others. So this would cover, I think, one of the first pillars in the roadmap development tool. We wanted perhaps to pause here to see whether there are any questions, I think, from the audience. And I'm pretty sure there's been some back and forth through the chat, but maybe Teco, I wonder whether we can stop here for 5 minutes to see whether there are any reflections before we move into the second decision area.
Thank you, Jonathan. In fact, we have received a few questions from the audience. Let me read the first question. In cases like Australia, in which there are some differences between local requirements and IFRS S1 and S2, will it be possible to state the reports are in compliance with IFRS sustainability standards? So when there's a discrepancy, few differences between local requirements to the IFRS standards, can it still be considered that it's compliance?
Yeah, thank you very much for that question. And if I can just summarize very high level, the differences are actually pretty narrow in the sense that one of the requirements that's currently not included in the Australian standards, it's a requirement to provide industry-specific information, but the standard setter has already announced that it has a project to determine that. They've also introduced the necessary elements of S1 into their S2 version directly. So S2 is an all-encompassing standard that brings together the relevant provisions in IFRS 1 in order to apply the climate-related disclosures on the basis of the Australian legislation. I also understand from the regulatory guide that the Australian Securities and Investment Commission has put together, as well as the provisions in ISSB standards, that they do encourage the full application of IAASB S1 and S2, so the Australian equivalents of S1 and S2. So preparers that actually want to go beyond the requirements, and there are only a couple of sections, including the need to provide industry-specific information and refer to and consider SASB standards, they can still do so in a way they can assert compliance with IFRS sustainability disclosure standards. So again, we are aware of those differences, and we do understand that the Australian standard setter is actually looking into a process to bring closer that degree of alignment, and anticipating already they will be mandating industry-specific disclosures later on. So they have built actually a system that is designed to deliver functionally aligned outcomes. But again, only those preparers and reporting entities that observe every requirement in ISSB standards will be able to assert compliance with ISSB standards. So that's a very specific requirement, but there's nothing in the regulation preventing preparers to do so.
Jonathan, if I may come in with a question. In the examples where there was a multi-stakeholder committee or advisory body to ensure a coherent approach, I assume that those didn't have a legal standing. So once they came up with a coherent approach, does it mean that every agency amended or introduced a regulation within their jurisdiction or within their mandate, or what kind of happened next?
That's a great question, Jana. Thank you for that. And again, I should have probably mentioned that a roadmap doesn't entail regulations. The roadmap is an articulation of a jurisdictional ambition. In those cases where a cross-committee has developed a joint roadmap, that means that those ambitions will then need to be articulated through different regulations. So whether it is the stock exchange, the central bank, the prudential authority, the insurance supervisory board, or whatever body is responsible for updating the companies or the corporations' laws, they will still need to follow and crystallize and give effect to the ambitions articulated in the roadmap. So yes, those committees don't have, in some instances, any statutory power, but it's very powerful for market participants, from the stakeholders, to hear what is the collective view of the regulators in a jurisdiction. And again, the roadmap will then need to follow with the relevant provisions. For instance, if it's a roadmap that anticipates that listed entities will be subject to regulations. Probably the listing authority, the stock exchange, or the securities regulator will need to issue regulations. Similarly, they will need to be complemented with companies' provisions if there are other non-listed entities that will be subject. So, but a roadmap brings together that consensus from the authorities, which I think it's very powerful as well in explaining the rationale for introducing regulation. But that's yeah, really good question, Jana. Thank you.
Thank you very much, Jonathan. There's another question from the audience. It's the latest one that we got. How does the standard address Scope 3 emissions in context of lending book of a bank?
Again, I think as many of you will be aware, I think the purpose of the seminar itself was to look more into the regulatory provisions. And again, we will not be covering the technical aspects of the standards. Again, what I can notice, of course, IFRS 2 has a requirement to disclose Scope 1, 2, and 3. And in particular, for financial institutions, there's a requirement as well for Category 15 in the GHG protocol around financed emissions. So there's already requirements in IFRS 2, in particular, with respect to requirements for banks, insurance companies, asset managers.
Okay, thank you very much for clarification. And I am just for the audience, I'm intentionally skipping some of the questions because I want to keep them at the end of the session. But I think that's it, which we would like to address now. And now I think we can move on to the next presentation, Jonathan.
Thank you very much. So I'll give the floor to my colleague, Mosi, to run the second decision area on reporting entities.
Thank you very much, Jonathan. Thank you for the presentation. So Jonathan took us through the first decision area of how jurisdictions can introduce sustainability-related disclosure requirements. Now here we are looking at determining the reporting entities. Once a decision has been made to introduce sustainability-related disclosure requirements, then there is need to consider those entities that will be subjected to the disclosure requirements. So in this session, we will have a look at what we refer to as the publicly accountable entities, as well as the publicly accountable entities in instances where there has been a market segment, as well as look at the reporting entity. The IFRS accounting standards are designed to cover the publicly accountable entities. And in the inaugural jurisdictional guide that we introduced and did an overview in the last session, the publicly accountable entities are basically referred to as those entities that have securities publicly listed, or that are in the process of actually listing their or issuing securities for public trading. And that also includes those entities that hold assets on behalf of outsiders as part of their primary business, which is actually a fiduciary capability. And then in that regard, the jurisdictional guide indicates that we will develop jurisdictional profiles, as Jonathan indicated, and in so doing, we will consider the extent to which the entities that will be subjected to the requirements cover or are applicable to all or most domestic publicly accountable entities. And the principle of all or most domestic publicly accountable entities actually covers those entities that have a higher weight or a significant weight in the economy, and does not actually consider or is not so much concerned about the number, but it's more about the weight of the entities when in the entire jurisdictional economy. So this would cover, of course, as I've already indicated, those ones that have their securities traded or those ones that have are holding us as a fiduciary capacity on behalf of outsiders, and those are indeed have a significant weight as well. So in some instances, you find that the publicly accountable entities have been segregated. Some are identified as Tier 1, Tier 2, or Tier 3, and some may have different names such as Prime, Premium, or Senior for the first tier. And therefore, the consideration here is, does the requirement or the coverage of the entities cover those entities that have a significant weight into the economy? Does it cover those ones that have a significant publicly traded assets? Does it cover those with a high revenue, and does it also cover those ones that actually have a larger shareholder base? So that is the one that we look at over and above just publicly accountable entities. And it is not always that all jurisdictions will have segregated their market, but where this is applicable, we'll look at whether the requirement are meant to cover the Tier 1 and Tier 2. So the other part that we'll consider is the requirement that is found in IFRS S1, that the sustainability-related disclosure requirements shall cover the same reporting entity as for the related general purpose financial statements. So those are the three that we have under the reporting entities, and that jurisdictions should consider when determining the reporting entities to be subjected to the sustainability-related disclosure requirements. One of the key things that will come at the top in this area is the policy rationale for introducing sustainability-related disclosure requirements. The reasoning behind the jurisdiction actually saying, yes, we will introduce sustainability-related disclosure requirement. It is that same reason that will assist the jurisdiction to consider the relevant entities to be subjected to sustainability-related disclosure requirements. And by so doing, they will, of course, look at the existing reporting framework, which Jonathan has already indicated, and also consider the extent to which those entities that are intended to be subjected will be applicable to publicly accountable entities. Of course, noting that here we are looking at the weight of these entities as may be measured by the GDP or the overall market capitalization of the jurisdiction. And in addition, you would note that what is important is to ensure that once a decision has been made to identify publicly accountable entities or entities that will be subjected to sustainability-related disclosure requirements, it will be important to determine ensure that there is a comprehensive approach to ensure that all these are covered. We mentioned in the previous session that Jonathan covered that there has been in different jurisdictions different regulators coming together to make a determination and build a roadmap. And one of the things that come from that kind of setup is that they are able to have a comprehensive adoption approach, because they'll be looking at the different entities that are regulated by the different regulators who at that time will be around the table. And that may ensure that there is that comprehensiveness and completeness to ensure that there is coverage of the entire ecosystem. And the other thing that should be considered then is the market readiness. How ready is the market to actually implement or apply the ISSB standards? And that will actually trickle down to how the requirements will be introduced within the jurisdiction. Some may decide that some requirements may be phased in over a period of time. Some may decide that the entities be scaled in. For example, to say we will start with Tier 1 publicly accountable entities, then move to Tier 2, and then the rest. Some may say we'll start with listed entities. Some may say we'll start with the financial institutions. That is the scaling that we are talking about. So there's the part of phasing in by requirements applicable to the rest of the reporting entities, and then there's also the part of scaling by sectors or the market or by the market market size. So this will be determined, the decision here will be determined by market readiness. So it's important that as regulators, you actually go on to actually do the market readiness assessment to make a determination of how the requirements will actually be applied. We'll look at this more when we look at the readiness, which is the third R in the next session. And then the other part that should be considered is the link, the connectivity between the related general purpose financial statements and the intended sustainability related financial reports. So the requirement in the standards is that the sustainability related disclosures must be for the same reporting entity as for the general purpose financial statement. So in you looking at the reporting entities, then you have to also reflect to ensure that that is also covered to ensure the connectivity between the two reports. Now in looking at the decision areas, once a determination has been made, then the key consideration that will have to be determined there is the extent to which the identified reporting entities will cover or will make up the domestic publicly accountable entities. That is, look at the categories of entities that will be required to apply the financial the requirements. That is, the financial institutions. Could it be financial institutions, listed entities, or entities meeting specific thresholds that may be determined within the jurisdiction? So, and then looking at that larger chunk of those ones that have been identified, do they make up all publicly accountable entities, or are there some that have been left out from that bracket? And then also assess the extent to which these identified requirements actually make up a significant weight of the jurisdictional economy. Of course, looking at the fact that they have to cover the publicly accountable status, as we have indicated. So for our profile, this is what we will look at when we make a determination of the outcomes that you can see at the bottom there to say, does it cover all or most? So it will be more to say those entities that have been identified, do they meet the all or most? Does it cover all or most part of it? And then the other part that we will consider is the means of introduce sustainability related disclosure requirements. So the jurisdiction will look at how they will do that, as indicated from in the previous slide, starting with the market readiness test. That will inform you as regulators to say, looking at the market readiness, we will now seek to start with this particular reporting entities, or we will rather start with this particular, or will introduce some reliefs in the initial year, of course, noting that we already have the transition standard reliefs in our standards. So these are some of the considerations that will have to be made, and also the extent to which the requirements will be applied for those entities without public accountability, as well as foreign publicly accountable entities. In some instances, some jurisdictions actually just say all publicly accountable entities within the jurisdiction will be required to apply the same sustainability related disclosure requirements. But in some, they may say, well, let's start with foreign publicly accountable, or they may decide to come up with different requirements for foreign publicly accountable entities. So here the jurisdiction will have to make a consideration to say, are all publicly accountable entities in the jurisdiction covered by the sustainability related disclosure requirements? We do take note that some jurisdictions actually have jurisdiction-specific definitions or thresholds for publicly accountable entities. And in some instances, there are some different wording that is used, for example, public interest entities. So for the purposes of actually building a jurisdictional profile, we will be looking rather at the publicly accountable entity definition provided for in the inaugural jurisdictional guide. And therefore, we'll be looking at the extent to which what the jurisdiction requires in terms of the reporting entities actually covers all or most publicly accountable entities as covered by the inaugural jurisdictional guide. So we have seen some reporting entities being introduced by different jurisdictions. Some actually went for most publicly accountable entities. Some selected publicly accountable, some of the publicly accountable entities. Later on, we will actually hear from Bangladesh, as indicated, who will share on their approach to start with financial institutions on their plan. And then we also have some that include Turkey and Australia that looked at specific threshold as determined in their local framework to say this is where we will start with this tier entities meeting this particular thresholds, and then maybe into the future, for example, in the case of Turkey, we will expand the scope. And then Mexico, they said they will start with listed entities, but not financial institutions. So these are just some of the examples that we have from the different jurisdictions. And then now going on to those jurisdictions who would have had different market segments in the form of either tier 1, tier 2, tier 3, the consideration that has to be made by a jurisdiction is whether if they require tier 1 and tier 2 to report, do those tier 1 and tier 2 actually cover the significant weight of the entities or the publicly accountable entities. And some of the things that have to be considered, of course, is whether those are actually or actually make up the larger share, the larger part of the GDP or the market capitalization within a jurisdiction. So you have to look at whether that is the case, or if there is need to expand the scope to ensure that publicly accountable entities are covered, all of them or most of them. So of course, as we are saying, this is what we'll be looking at in our profile. And we have seen some jurisdictions actually taking that kind of approach to say we are phasing in the requirements, starting with tier 1, and then the following year we'll go on to tier 2. But then our target approach is to ensure that all entities in a particular sector or all publicly accountable entities, as may be determined, do report in accordance with the ISSB standards. Now, as indicated, the IFRS S1 does require that the reporting entity be the same for sustainability-related disclosures and general purpose financial statements. And therefore, as jurisdictional regulators, you ought to determine whether that is the case in your situation. That is, whether the sustainability-related financial disclosures will be required for the same reporting entity as for the related financial statements. Consideration will be made even for where consolidation is required, to say, does the requirements therefore cover the consolidated financial statements, or there is a requirement for separate financial statements. And then so the consideration there will be more of, does then the intended approach align with the principle of the standard to have the same reporting entity for sustainability related disclosure requirements and general purpose financial statements. So that covers the part on reporting entities. I'll stop here and then see if there are any questions before we go on to the next steps, after which we'll introduce Bangladesh. Taiko, I don't know if there are any questions that we can take at this stage.
Yes, there is a question about capacity building. Please see that I would like to address. Do you provide training and capacity building to regulators as well as those who can support implementation, whether it's international or national organization, to build the community of practice of the ISSB standards at the region and country level? Mosi or Jonathan, can you?
Happy to take this one. Yeah.
Great, thank you very much.
Yeah, thank you very much, Apar, for the question. And indeed, I think the fact that we are today with SBFN addressing regulators is part of our willingness to continue to support regulators in their process. I think, we have similar programs together with IOSCO, its Growth and Emerging Markets Committee, as well as with some regional bodies. I think, of course, we need to be cognizant that we have limited resources and that we need to be effective in the way we are trying to engage with all stakeholders, including regulators. We very much agree with you that capacity building is needed across different stakeholders. And we do have a regulatory affairs team precisely because we're keen to engage with regulators and continue to support capacity. As we articulated, I think, in our regulatory implementation program, we see our role as standard setters as developing the materials, tools, and resources that others that have the mandate to equip and support regulators can use for the implementation, for the adoption, for the proper supervision and enforcement of ISSB standards. So it is very much our willingness, and to the extent that our resources permit, we are very keen to continue to cooperate with the platforms that allow us to maximize our reach. So delighted to partner and team up with SBFN, for instance, so that you can have access to these tools.
Thank you, Jonathan.
Thank you very much.
Just to add from our side that SBFN, together with IFC, has a capacity to support regulators and industry associations in this journey. We will hear from the Bangladesh Bank that was actually supported by our colleagues, IFC colleagues in the country, in the development of the standards. In the last webinar, we heard from our partners, GIZ, that supports other jurisdictions. So there definitely is kind of capacity among the international partners and the international organizations to support you. If you have any kind of specific requests, feel free to reach out to us, and we can always kind of think who is the best positioned to take this on. I have a question for Mosi about the reporting entities that I'm sure is on the top of everyone's mind in this room, which is, what about the micro, small, and medium enterprises, or the MSMEs? How do you see the jurisdictions approaching those? Are they being included, phased in, or excluded completely?
Indeed. Thank you very much, Yana. So we have seen some jurisdictions actually including small to medium enterprises amongst those ones that are required to do the reporting. But what we have seen is that they are phased in. They are left to come in right at the end. For example, in the case of Nigeria, we have seen that they have started with the public interest entities, and then they are saying at a later date, then the SMEs may come in. So it varies, whereas in some instances, they just require, the focus is only on publicly accountable entities. But the SMEs, in some instances, they are required to actually be report, but at a later date. However, for the purposes of the IFRS Foundation's jurisdictional profile, the focus, as we indicated, will be only on the publicly accountable entities than the SMEs.
Thank you very much, Mosi. There's another question about the reporting entity from Karen. It's the question about if the company is required to report on joint ventures related information in their disclosure. Is this something part of ISSB standards requirement, or is this something that you see companies or reporting entities report on their financial statements or disclosure?
Maybe Mosi I can take this one. I think we will be looking more specifically into some of the specific requirements that are in ISSB standards in the next webinar, the next session, when we look into what are exactly the requirements. One of the requirements in IFRS S1 is that the reporting entity needs to be the same as the one for the financial statements. So it needs to be exactly the same entity. It's true that there are considerations around value chain. There is information that needs to be brought, but the requirements need to be for the same reporting entity. So the same formulation that has been applied to come up with the reporting entity in the financial statements should be followed for the determination of the reporting entity and its related sustainability risks and opportunities on the sustainability side.
Great, thank you very much, Jonathan. And thank you everyone for the engaging questions. Now I'd like to move on to the next presentation. I will give the floor back to Jonathan and Mosi for the next presentation. Thank you.
Yes, thank you very much, Taiko. So just to wrap up this one and conclude, we'll look ahead and say at the next session in June, we'll actually now look at the remaining two R's, being requirements. Under requirements, we'll actually look at the degree of alignment, that is the extent to which the local requirements or the ISSB standards requirements actually transposed into the jurisdictional requirements, and if not, the extent to which they are designed to deliver functionally aligned outcomes. And also we'll look at the jurisdictional modifications, that is the impact that any local requirements actually have led to modification of the ISSB standards, including the additional disclosure requirements over and above what the ISSB standards are requiring. Does the jurisdiction provide for any further requirements and the implication thereof? And also the placement of the disclosures. The standards, as you know, they require that the sustainability related disclosures be part of general purpose financial reports. So we'll look at that as well, and the impact of dual reporting where a jurisdiction may provide for such. And then subsequently, or to conclude this, the next session, we'll also look at the readiness, that is the when, which covers two aspects, that is the date when the local requirements are expected to effect, as well as the transition reliefs. So these will cover the readiness, which we talked about earlier on. That is the transition reliefs here will cover the phasing in or the scaling. Are there any scaling in that are provided, or are entities phasing the requirements into the towards the targeted date of the local approach? So this is for the next session that Jana will also invite you to at the next session in June. So with that, we have come to the end of the ISSB presentation, and I would like to thank you for your kind attention. And at this point, let me stop my presentation and invite Mr. Chaudhry to come in. I'll present on his behalf. Mr. Chaudhry Liaquat Ali, as introduced, is the Director of Sustainable Finance at the Bangladesh Bank. Mr. Chaudhry, if you can come on your video and then run with it.
Okay, thank you, Mosi. So you start my presentations, and you will be operating my presentation. So please show the first slide. Okay. Now I am audible to all.
Yes.
Okay. This is Chaudhary Liaquat Ali, already given that introductions by the Mercy from the Bangladesh Bank. This is the Central Bank of Bangladesh. Just before coming to the actual points, just I would like to share our experience. Actually, we are the climatically vulnerable country in the globe, as all of you know that in the rank of 7. That's why Bangladesh Bank established a dedicated department. This is the Sustainable Finance Department. And why we established this department? The aim of the establishment of department is that to support to the government for achieving the sustainable agenda on the climate related adverse, for combating the climate related adverse activities by giving the some policies. That's why a lot of policy has been given to the financial industries for greening the financial system of our country, like a sustainable finance policy, environmental and social risk management guidelines, and also the green bond policy for the banks and FIs, like that. And why we actually adopt IFRS S1 and S2. Actually, we adopt this IFRS S1 and S2 in 26 December in the year 2023 by issuing the guideline on sustainability and climate-related financial disclosure for banks and finance company. The main objectives of these guidelines to help the banks and financial institutions integrate the sustainability and the climate-related consideration into the core governance strategy, risk management frameworks to identify, to assess, and manage the environmental and social and climate-related risks and the issues associated with the opportunities. So after adopting this guideline, IFRS S1 and S2, by issuing these guidelines, Bangladesh is the first country to receive 1.4 billion funds from the IMF Resilience and Sustainable Fund under the budget support loan. So initially, actually, we are thinking the adoption of the TCFD recommendation. But in the meantime, IFRS standards already disclosed, and we came to know that all standards who is given by the TCFD already adopted IFRS Foundation. That's why we issued and adopt the IFRS S1 and S2 guideline. Next slide, please. So this is the this slide actually designed under the IFRS Foundation's means the structure of the roadmap. That means the how, who, and why, and the what, like that. So the regulatory and the legal standing actually is required, and the publicly accountable entities, that is the all banks and finance companies of Bangladesh, and the market segments, also the all listed and non-listed finance company. Actually, we have the 61 banks and the 35 finance company, that is the non-bank financial institutions. Out of the 61 banks, why we include the non-listed? Because out of the 61 banks, 3 government or state-owned bank actually not listed in the stock exchange, and the 6 specialized or the development bank not listed in the stock market. But all of the listed and 61 listed and non-listed bank under our scheduled bank. That's why we actually impose or the regulatory restrictions for the to follow the our instructions. And reporting entity, same the same entry, that is the listed and non-listed bank and finance company in their financial statement. Next slide, please. And in case of the degree of alignment, actually full alignment with the ISSB standard. And in case of the placement, actually this is the general purpose of the reports, and also disclose at the same time in their related financial statements. And there is actually dual reporting is not required, because as earlier I said that we have a environmental and social risk management guidelines that include an ESDD checklist. That means the environmental and social due diligence, which will be mandatory for all banks and finance company. If any bank and finance company taking their any lending decisions, they must be comply the ESDD checklist. And jurisdictional modification, actually not significant, no or not significant modifications is there, and also the no additional information is required. And the readiness, already this guidelines is effective, and the we are actually the transition standard reliefs we followed only, but as per the GSG protocol is the voluntarily for the first year. And the next place. Here I have shown you that how the implementation pathway in the as per our instructions, banks and finance company started reporting to the central banks, that is the Bangladesh Bank, under our regulatory template. Actually, when we giving the guidelines, we give the some regulatory template which should be reported to the central bank in the from the year June 2024, that is the semi-annually. And in the year, actually, you have seen that in the third step, in the year 2025, all banks and finance company disclosed their this sustainability and climate related informations in their annual report. That's why we are follow the transition standard relief. And in the year 2026, again we keep the some additional requirements. That is the limited assurance, because limited assurance given by the external auditors, that means the chartered accountants. So we give the some breathing space to the chartered accountants for their building their capacity and for adopting or aligning the ISSB standards. And in the year 2027, there is the full disclosure we adopt, and bank and finance company should disclose their S1 and S2 related information in its annual report. Next slide, please. And how Bangladesh Bank actually assisting the banks and finance company. We, along with the IFRS S1 and S2, Bangladesh Bank circulated a reporting template where I mentioned earlier, a reporting template, and bank and finance company report by the regulatory template by semi-annually. And Bangladesh Bank has signed the memorandum of understanding within the global renowned international organizations for calculating the finance emissions of banks and finance company. And the organizations has already calculated finance emissions of 10 banks and finance company in the year 2024. Next slide, please. And Bangladesh Bank just try to bridge the bank and finance company and the other organizations engaged in calculating the finance emissions to have a memorandum of associations between the banks and finance company or the organization. As for example, partnership of the carbon accounting financial, this is the BCAP, signed an MOU with some banks. And expert members of my teams, that is actually my team who deal with the during the development of the guidelines or the circulars. So in the meantime, they have gained expertise and knowledge. So now we actually my team is working for a separate calculator for the finance emissions for the bank and finance company. Once we develop the finance calculator, then we actually circulated these calculators to the banks and finance company for a reporting purpose. Next slide, please. And Bangladesh Bank is also working to finalize a finance emission calculator that I said earlier for the banks and finance committee, and also prepared a guidance note to assist the banks and finance company in addressing the information's required disclosure. Because actually under the 4 content pillars, that the governance, strategy, risk management, and the metrics and targets, we actually facing the challenges on the calculating of the finance emissions. That means the metrics and targets, because actually we instructed our banks and finance company at first they set their targets of emissions with in aligning with our NDC target. Then they achieve their targets in that way. And Bangladesh Bank also searching for every opportunity for the capacity building of the banks and finance company and the concerned officials of the central banks. Next slide, please. And other than the banks and finance company, actually Bangladesh Bank is the regulator of the financial industry. We only responsible for the banks and finance company, not the industry and the corporates or the insurance, because we have separate regulators for the insurance company, and we have regulators for the corporate, and the nationwide adaptations, that is the nationwide IFRS S1 S adaptations, actually responsible the Financial Reporting Council. That's why we Financial Reporting Council already formed a committee for formulating developing the sustainability and the climate related financial disclosure with aligning with the IFRS S1 and S2. And this means the director of the sustainable finance is the member of the this committee for giving the expertise what we already have learned for during the development of the guidelines. And our next slide, please. And our next agenda or the next step is that updating our environmental and social due diligence to fully comply with the required impact materiality European sustainability standard, that means the ESRS, so that both IFRS S1 and S2 and the ESRS standard can be assured for the financial sector. So we are working to improve our data quality and the database for the finance emission. So this is my presentation, and the little presentation which I believe that which will I try to make my understanding regarding the IFRS S1 and S2. Thank you, Flip.
Thank you so much for this presentation. It's interesting to hear that the work of the bank doesn't stop just by publishing the regulation, but there's so much other efforts coming into the capacity building and then alignment within the country itself. We received 2 questions for you with regard to this experience. And one is, how are you integrating the ISSB standards with the national green taxonomy developed by the Bangladesh Bank?
Yes, actually, this is the good question. Green taxonomy. Just I would like to share that actually we prepared or we established the green taxonomy only for the banks and finance company. So you minded that this is our taxonomy is not the national taxonomy, green finance taxonomy. This is only for the banks and finance company. So when we develop this IFRS S1, S2, just we align our green finance taxonomy. If you go through our green finance taxonomy, where actually under the sustainable finance taxonomy, we include the 3 taxonomy included. One is the green finance taxonomy, second one is the sustainable finance taxonomy, third one is the climate finance taxonomy. And also we designed the green products that and as well as the green sectors. We designed 94 products under the 14 sectors for the green taxonomy. And why we actually designed the green products? Actually for easier and to facilitating the financing in those areas. That's why we give the product list. So for the finance emission calculations, this taxonomy or product will be helpful for the finance emission calculation. That is, I said.
Thank you. And the other question related to your experience, if there is any proposed metrics to report with regards to reducing vulnerability of climate change or reduce loss and damage from the bank's finance activity, or how the financing has been enhancing the resilience or adaptation.
Okay. Actually, now we are working on the climate risk management guidelines that we include the climate risk matrix, that is the physical and transition. But I would like to mention is that regarding the climate change loss and damage, actually this is under now in our country, actually this loss and damage is conducted by our government under the fiscal policy. But we are working on the for designing or the identifying the bankable product for the loss and damage. But actually we have a guideline for the corporate social responsibility. We instructed to the banks and finance company for the corporate social responsibility. If any bank and finance company budget for the CSR, that means the corporate and social responsibility, under the CSR, 20% of the budget should be transferred to the climate risk fund. And the climate risk fund will be utilized for the climate change loss and damage financing under the low cost or the cheaper rate. This is one. And another one is this, that we are now working the climate damage functions for the financial assets. So, and parallel, actually, two things we are working. One is the climate risk management guidelines, and another one is the climate damage functions for financial wise. So I believe that if we develop these two guidelines, the climate change loss and damage financing problems will be solved. Thank you.
Thank you very much, Mr. Chaudhry. Another question from the audience I would like to ask asked to Jonathan or Mosi. So ISSB suggestion of the disclosure location be part of the general purpose of financial reports. And as seen in the example Bangladesh Bank, they're requiring the institution to include the disclosure inside the annual report. From this example, is it possible, acceptable if banks have the disclosure in a separate report, such as sustainability report? Does it still meet the requirement of being part of general purpose of financial reports? I would like to ask to either Jonathan or Mosi if you can address. Thank you.
Thank you, Taiko, and thank you, Karen, as well, I think, for the question. Another very good question. So there are two elements here. One is, of course, what is the definition of what a general purpose financial report is? And that's the definition that's already contained in IFRS 1. And I think we also note about that requirement, and we articulate that there are possible different suitable reports, vehicles to disclose general purpose financial information. And we note can be part of the annual report, can be part of a sustainability report, can be a separate report, can be as part of an integrated report, but it needs to be part of a general purpose financial reports. And these are reports that are intended to provide financial information about a reporting entity that's useful to the primary users in making decisions relating to providing resources to the entity. And again, the timing issue, it's important. It's information that needs to be disclosed and released at the same time as the financial information. So an investor, a shareholder, a primary user can make decisions on the basis of having both sets of information at the same time. So the fact that it's integrated within the annual report or separate, it doesn't entail whether the requirements will not be met. It is whether the jurisdiction prescribes that that report is part of the general purpose financial reporting for the reasons and the objectives that are articulated in IFRS 1. So separate report can be compliant to the extent it is part of general purpose financial reports. And of course, it's released at the same time as the related financial statements, acknowledging the transitional reliefs that are already included in IFRS 1. I hope I've covered that one.
Thank you so much, Jonathan. Yeah, thank you, the IFRS team and the Bangladesh Bank, for your insights. We are right on time, so I don't want to keep anyone longer, but I do want to thank everyone for your participation. Please do not forget to register for the next and the last webinar, which will take place on June 5th. We will cover the remaining 2 R's, requirements and readiness, meaning we will be looking at what requirements can be included in the regulations and how it can be rolled out and any reliefs that can be considered. We will continue answering your questions, even the ones that were not addressed today. And the recording of today's session and the presentation will be shared on SBFN website and via email. And do not forget that if you attend all 3 sessions, you will be issued with the certificate of completion. And with that, thank you and see you on June 5th.